I once read that the average person checks their investment app more often than they check on their own parents. Think about that for a second. We obsess over the number going up and down every day, but almost nobody sits down and actually builds a portfolio with a real structure behind it. We just buy things, random things we saw on a screen for 4 seconds. I've read the investing classics, Benjamin Graham, John Bogle, Burton Malkiel, Morgan Housel, and strip away all the jargon and they're all circling the same 20 truths. Today, I'm giving you those truths as rules. Simple, practical, no finance degree required. By the end of this video, you won't just own stocks, you'll own a portfolio. There's a difference, and it's the difference between wealth and wreckage. Let's get into it. Benjamin Graham, the father of value investing, spent his career trying to protect regular people from one mistake, treating the stock market like a casino instead of a business. Here's the analogy that fixes it. A pile of stocks is a crowd, people standing around with no plan, no formation, nobody covering for anybody else. A portfolio is a team. Every player has a job, a position, a reason for being on the field. Your defenders are the boring, stable assets that protect you when things get rough. Your midfielders connect everything, usually your core index holdings. Your strikers are the higher risk, higher reward pieces that score the big points. You don't win championships with 11 strikers. You don't build wealth with 11 lottery tickets either. Rule 2. Know your timeline before you know your ticker. Every investing book worth reading says some version of the same thing. Risk isn't a fixed number, it's a relationship between your money and your calendar. Money you need in 2 years and money you won't touch for 30 years are not the same money. They should never live in the same kind of asset. Before you buy a single share, answer this. What is this money for and when does it need to show up? Retirement in 30 years behaves completely differently than a house down payment in 18 months. Confuse the two and you'll either take too much risk with money you can't afford to lose or too little risk with money that had decades to grow. Timeline first, ticker second, always in that order. Rule 3. The market is a voting machine short-term, a weighing machine long-term. This idea comes straight from Benjamin Graham, and it's one of the most quoted lines in investing for a reason. In the short run, stock prices move on emotion, headlines, and mood, like a room full of people voting on what they feel like today. In the long run, prices settle around what a company is actually worth, like a scale that doesn't care about feelings, only facts. New investors panic because they're staring at the voting machine. Wealthy investors sleep fine because they're building for the weighing machine. Your portfolio should be constructed for the scale, not the mood ring. Rule 4. Don't try to find the needle, buy the haystack. Burton Malkiel wrote an entire investing classic around one core idea. Trying to pick individual winning stocks consistently is closer to a coin flip than a skill, even for professionals with teams of analysts. His famous line was that a blindfolded monkey throwing darts at a newspaper stock page could do about as well as an expert. Harsh, but the data backs it up. So instead of hunting for the one needle stock that outperforms everything, buy the whole haystack. A broad market index fund gives you a slice of hundreds or thousands of companies at once. You stop betting on one outcome and start owning the entire distribution of outcomes. The winners carry the losers, and history shows that combination wins over time. Rule 5. 90% of returns come from where you put your money, not when. Think of it like planting a garden. Where you plant the seed, in the right soil, with the right sunlight, determines almost everything about how it grows. Constantly digging it up to check if today was the right day to plant does more damage than good. Your allocation is the soil. Get that right first. Stop obsessing over the perfect planting day. Rule 6. Behavior beats brains. Morgan Housel, in his work on the psychology of money, makes a point that should be tattooed on every new investor's brain. Doing well with money has very little to do with how smart you are and everything to do with how you behave. He tells the story of a janitor who quietly amassed an 8-figure fortune through decades of patient, unglamorous investing, while plenty of highly educated professionals went broke chasing complexity and speed. Intelligence picks the investments. Behavior determines whether you actually keep them long enough to work. Your portfolio doesn't need a genius. It needs someone who won't blow it up during a bad month. Rule 7. Diversification is the only free lunch in finance. Harry Markowitz, the economist who basically invented modern portfolio theory, famously called diversification the only free lunch in finance, meaning it's one of the rare moves where you reduce your risk without giving up expected return. Picture carrying groceries home in one flimsy plastic bag versus splitting them across 3 sturdy ones. Same groceries, same weight, but if one bag rips, you don't lose dinner. Spread your money across different sectors, different company sizes, different regions of the world. When one bag rips, and one always eventually does, the rest of your dinner is still on the table. Rule 8. Build in layers like a house, not a pile like a heap. A strong portfolio isn't flat. It has structure the same way a house has a foundation, walls, and a roof. Layer 1 is your foundation, broad index funds covering the total market. This is the biggest chunk, especially early on, because it's built to survive anything. Layer 2 is your framing, dividend payers, bonds, international exposure. This adds stability and income without sacrificing too much growth. Layer 3 is your roof, a smaller slice, maybe 5 to 15% for individual stocks or higher conviction bets. This is where you can take a swing, but the house doesn't collapse if the roof leaks a little. Most people build a portfolio backwards, all roof, no foundation. Then they're shocked when the first storm takes the whole thing down. Rule 9. Time in the market beats timing the market. This phrase gets repeated so often it's become a cliche, but John Bogle, the founder of Vanguard and the man who basically invented the index fund for everyday people, built his entire philosophy around it. Bogle's research showed something almost every investor refuses to believe about themselves. Missing just the 10 best days in the market over several decades can cut your total returns dramatically. And nobody, not fund managers, not algorithms, not the loudest voice on financial television, can reliably predict which days those will be. So the strategy isn't to guess the perfect entry point. The strategy is to already be in the market when the good days happen, because they show up without warning, usually right after the scariest headlines. Rule 10. Pay yourself first, then invest what's left over of nothing. Ramit Sethi built a whole philosophy around one deceptively simple habit: automate your investing before you ever see the money, because willpower is an unreliable financial plan. Most people invest with whatever happens to be left over at the end of the month. The problem is there's almost never anything left over because spending expands to fill whatever is available. Flip the order. The moment your paycheck lands, a fixed amount moves straight into your investments before you can touch it. You're not budgeting your way into investing. You're removing the decision entirely. Rule 11. Dollar cost averaging turns volatility into your employee. Here's a trick almost nobody explains properly. When you invest a fixed amount every single month, no matter what the market is doing, a falling market isn't bad news anymore, it's a discount. Same dollar amount, lower price means you automatically buy more shares when things are cheap and less shares when things are expensive. Over time, that averages out in your favor without you having to predict anything. Most people see a market drop and feel robbed. A dollar cost averager sees a market drop and feels like they just walked into a sale. Rule 12. Rebalance like a captain adjusting sails, not abandoning ship. A portfolio isn't set it and forget it forever. It's set it and adjust it occasionally, calmly. Once or twice a year, check your allocation. If your growth layer had an incredible run and now makes up way more of your portfolio than you planned, trim it back towards your original targets. If your foundation grew heavy relative to your growth layer, add a little more there. A captain doesn't panic and jump overboard every time the wind shifts. A captain adjusts the sails and stays on course. Rebalancing is you quietly adjusting the sails. Twice a year, nothing dramatic. Rule 13. Fear and greed are the only two forces that ever wreck a good plan. Warren Buffett's most repeated piece of advice is deceptively short. Be fearful when others are greedy and greedy when others are fearful. Almost every investing disaster in history traces back to one of those two emotions overriding a perfectly good plan. Greed convinces you to chase whatever's already up 100% this year.
Fear convinces you to sell everything the moment it drops. Your portfolio's biggest enemy was never a bad market. It was always the version of you that panics at exactly the wrong moment. Build the plan while you're calm so it can protect you when you're not. Rule 14. Costs are the termites of compounding. John Bogle spent decades warning about something most new investors never think about: fees. A 1 or 2% annual fee sounds small. Over 30 years, compounded, it can quietly eat a massive chunk of your total wealth, sometimes hundreds of thousands of dollars. Termites don't knock the house down in one day. They work silently, year after year, until you realize the structure was hollowed out the whole time. Low-cost index funds exist specifically to keep the termites out. Check your expense ratios. It's one of the few things in investing you can actually control completely.